This is what I'll be doing if a war type event happens and the stock market crashes. So in today's video, I'll be covering a few things. I'll be covering what I'm doing in World War III if it happens, Google stock, the largest companies in 2030, as well as some questions in the comment section below. So let's talk about World War III and stocks falling first. Iran has officially been attacked by the Americans. The Americans have actually bombed some of Iran's nuclear facilities, and currently now we're awaiting the Iran response to the Americans itself. I expect the Iranians to respond to the Americans, similar to what they did in 2020 as well. So this event will likely cause some form of panic in the markets, but if you're to look back historically, every single time there was an invasion, it was sort of like a buy the dip opportunity. Every single war, there was a dip when the invasion happened, and then as soon as the market started pricing in all these events, the market just shot up from then on. So this is how the market works. The initial news will have an impact, but every subsequent event after the initial invasion will be a lot less impactful as compared to the original one, and that's why your markets will run after the war has happened itself. So, but what if the market crashes? So what I'll do is, I'll hold, I'll sleep, and then I'll buy the dip. There shouldn't be any worry if you're holding high quality companies because they can survive any sort of economic environment, and if you're feeling uneasy, then you're probably holding weak stocks. So if a war happens, all these different businesses, Meta, MSCI, Microsoft, MasterCard, all these businesses, they'll still be operating well. So I don't see a problem with holding them through all these times, unless there's something happening fundamentally or structurally to the business itself. You shouldn't let all these macro events affect your decision when it comes to buying or selling of stocks. Of course, if the discounts come, then it'll be time for you to deploy your cash into the market. But you should never be selling your stocks because a war is happening. More often than not, the truth is a lot less severe than what is being put out there by the news outlets. In summary, this is what I'll be doing if a war actually happens. I'll just be holding on to the stocks, I'll be buying the dip if the opportunity comes, and I won't be selling any of my stocks unless I feel the company is not doing well fundamentally. I won't let this macro event, I won't let this war affect my decision when it comes to holding on to all these different stocks. Next portion, I'll be talking about Google stock. So this is what Monish Prabhai has said about Google. Let's listen to this one over here.
Faces real challenges in its core business. Now, they've got, if you look at something like the YouTube franchise, that's just so spectacularly mind-blowing that, it's a rock, not going anywhere. And of course, Android also is great. But I'm just saying that search is threatened in a way that it wasn't threatened a few years ago. And Google has woken up to this. They're fully focused on it. They'll probably come out okay, but it's not the cinch that it was a few years back. So to me, the Google multiple being low isn't really a strong signal that one should go out and buy the stock. I think that the one that I really think is as close to bulletproof as you can get is Microsoft. I think because Microsoft is so embedded in the enterprise, and because enterprises are like aircraft carriers, they cannot turn on a dime. They can't suddenly say, "Oh, I'm going to use someone else for search tomorrow." We can make a decision 5 minutes from now to never use Google search and not even think about it again. But you can't do that with a lot of Microsoft products.
So when it comes to Google's business, the search is threatened, and the risk for shareholders right now is Google's innovation risk. So the company has to innovate and stay ahead of the game. If not, it will be risky for the shareholders itself. And this is a dangerous situation for Google shareholders today. Because for Google, it is trading at a cheap valuation, but it is facing competition that it has never faced in the past as well. You have LLMs coming up and you never know how good they will be in the future and how it will affect the consumer experience when it comes to search. So for Google, that is the problem with the business today. And I actually found this Google bear thesis online as well. So this Twitter account actually said, I think Google is a value trap. Here's why. Google looks like a bargain, 2 trillion market cap, dominant market share, 25+% margins, cheap versus peers, but under the surface, it may be a classic value trap. Google search is in a slow structural decline. Yes, revenue still grows. Who's love pointing this out, but mostly from higher ad prices, not usage or engagement. The experience has degraded. SEO spam, paid clutter, AI written garbage. More people are turning to TikTok, Reddit, Amazon, and even ChatGPT for the kinds of queries that used to belong to Google. So the counter argument to this is that Google is innovating. Google is coming up with AI searches which are equally monetizable as compared to the classic Google search. So Sundar Pichai has previously came out and said that AI overviews are almost as profitable as compared to your normal standard Google search. And I think overall that is okay for the business as well. So the other points that he came out with as well is that Google isn't winning in AI. Google is defending itself from it. Every time Gemini gives you a direct answer, that's one less monetizable search result. The better it gets, the worse the search business becomes. AI is a margin headwind, not a growth engine. And then they also mentioned that Google Cloud is growing, Android is dominant, YouTube is still huge, Waymo might be something else, but none of these companies will move the needle for a $2 trillion company. These aren't hidden assets, everyone knows about them and they're consolidated. So number one, he's saying that Google isn't winning AI, Google is defending itself against it. I don't think I agree with that one. Google is currently winning in AI. If you were to look at the VO3 and all the advances when it comes to Gemini as well, the company is integrating an entire ecosystem into its Google workspace, and the company is also integrating AI into the original search portion as well. And the ROIC metric for the company is still strong. In fact, it is growing over the past few years despite of ChatGPT. So ChatGPT has been released for about 2 years already, and yet you're still seeing Google's ROIC increasing over the past 2 years. As for Google Cloud, YouTube, and Waymo, Google Cloud is currently growing revenues at around 30%. So you can expect the net income to grow by around 50% or so for the next few years. And if they can continually grow Google Cloud as well as Google YouTube for the next 5 years or so, it could make up to around 30 to 40% of the entire net income of the company. So while it is true that Google is still reliant on Google search, to say that it wouldn't move the needle at all, I disagree with that. And he also said that these aren't hidden assets, everyone already knows them and they're consolidated. So I disagree with this one as well. So the everyone knows them argument is a weak one. Everyone knows about Apple, for example, and yet Apple has still been a quality business to own over the past 10 years, past 20 years. Microsoft, everyone knows about them as well, and yet it's still doing extremely well. So everyone knowing that Google Cloud, Google YouTube, Waymo is present today doesn't mean they won't do well in the future. So I don't necessarily agree with this one as well. But for Google, I see it as a less predictable business now. I'm holding it because of the undervaluation, and it is one of the riskier bets in my portfolio. It's not the weakest company in my list, but it's one that faces the most risk today, I feel. I'm still overall bullish, but the predictability of the business is a lot lower as compared to all the different names in my portfolio. So as Monish Prabhai has said earlier as well, Microsoft is a lot more predictable. It is almost bulletproof as compared to Google search. I'm holding on to it, but let's see how this one plays out. And they have the regulatory problems as well coming up in August. So let's see what happens with the DOJ lawsuit as well. Next portion, I'll be talking about the largest companies in 2030. So this is Cortu's Fantastic 40, and they have a lot of different companies over here. They have Microsoft still holding the first spot, Nvidia holding on to the second position, which is quite interesting. And then they have other positions as well, like Amazon, Meta, TSMC, Tesla, Broadcom, OpenAI as well, Oracle, Tencent, and so on. So if you were to arrange them based on their internal rate of return, this is how they will look like. So they're placing ARM as the highest one up there. So ARM is actually a company that is involved in your CPU portion. So they're betting on the fact that a small company like ARM will be able to basically 7x their market cap in a span of 5 years. And then he has other companies in here as well, like Stripe. Stripe is a company that hasn't IPO'd yet. Then you have Databricks. All these are private companies here, so we'll ignore this one first. And then you have AppLovin, Oracle. Oracle is an interesting one. And then he has Tesla up here as well. So Tesla is a company that still doesn't have their robotaxi fleet. So I'm not too sure how that one will play out. So apart from that, there are other companies that I would like to highlight as well, which is TSMC. I view TSMC as a high quality business. But the problem with the business itself is that there is risk of the company going to zero simply because it is located in Taiwan. As for other companies that are interesting as well, we have other companies like Spotify, Shopify. These two companies, they're quite interesting. Spotify is a company that has a dominant position in our streaming space. And in the music streaming space, it is projected to grow at around 5 to 6% for the next 5 years or so. So there is still a lot of growth ahead for Spotify, especially since they're transitioning from sort of like growth to profitability of the business itself. And then for Shopify, I just view it as a company that will always still be here for small businesses, and they will never be eaten away by all these different bigger giants. So Shopify and Spotify, they're two interesting companies as well. Then you have other companies like ASML and so on. Last portion, I'll be covering some questions left in the comment section. So the first one, it says, maybe it would make more sense to look at the forward P ratio of the S&P 500 given the strong EPS growth of the underlying businesses, which will make the current valuation a lot more palatable. According to FactSet, the forward 12-month P ratio for the S&P 500 is 21.6 times. So yes, it's correct. The P ratio over the next 12 months is projected to be around 21.6 times. But if you were to look at it historically, the S&P 500 is actually trading at quite an elevated valuation. So we're currently trading at 21.6 times. The 5-year average is at around 20 times. The 10-year average is at around 18.4 times. So the market valuations elevated today, I think it is better to stay cautious because historically this is on the higher side and we're projected to have a lot more EPS growth ahead because of AI and all that. But if that growth slows, then the forward P ratio could go a lot higher than what it is today as well. And that's why I'm still staying cautious. Markets are still on the expensive side. So hopefully it dips back down to more of a fair valuation so that it is more reasonable for you to buy into all these different stocks. Next one, it says, true quality are the ones you can buy and hold. Speculative IPOs require some market timing because you have to exit before they eventually mean revert to their intrinsic value. The benefit to IPO investing is that successful ones can become multi-baggers, but picking the right ones are difficult. Most don't survive and you're riding that volatility, which is so much easier said than done. So I completely agree with this one. In fact, majority of IPOs, they fail over time. So when you're seeing people online buying Circle, buying all these different IPO companies, that should raise an alarm bell because more often than not, there will always be the IPO craze. And then as soon as retail stops chasing the stock, that's when you see the stocks mean revert back, and then they'll crash around 40-50% or so. So when it comes to owning stocks, the best way, in my opinion, is just to hold high quality compounders that can give you high returns on investment. And over time, all these compounders, they will compound intrinsic value to give you market beating returns as well. So I'm not into all these different IPO stocks. I'm sure you can make good money with it, but for me, I'm staying out of this ones. I hope you guys have found this one useful and invest safe.